Okay. Peter Rose, Longwood Currency Trading. Good morning. It's a beautiful mid-June morning in 2021. And I thought I'd do this video outside. Actually, I try to do as many videos outside as I can because I'm in at the trading desk or writing or doing something all the time inside anyway. So it's nice to be able to get out and chat with you folks. Particularly interesting is if you take a look at the house, if you've seen any of my videos, you'll notice I have a new metal roof as opposed to a shingle roof on the house. It was in desperate need of it, and if I think of it, I'll post a couple of pictures along with this video of the process. Yes, it was quite a process that it went through. So the video that I want to do today is exiting a trade gracefully. And by that I mean you exit because you choose to as opposed to because you have to. The operative word there between getting out of a trade because you choose to as opposed to because you have to, that's really the operative thing to discuss. In teaching martial arts and self-defense for 50 years, one of the things that I tell people is that we develop the skills that we have not to fight, but to not fight. And the reason for that is we're not presupposing that we're going to win. It doesn't really make any difference. Survival has nothing to do with winning, and it has to do with standing up for yourself and dishing it out as well as you're going to get it. And the point of training in martial arts to be skilled is not to brag about it or whatever, but it enables us to have the confidence to know we're not going to be pushed around and that we will stand up for ourselves. And so that we can walk away then from a potential physical confrontation because we choose to do so as opposed to out of fear. And trading is the same way. Look, we're dealing with our human emotions and things, and if you're exiting your trades because you have to, that's just adding to your fear and your feelings of inadequacy. You always want to exit a trade because you choose to. Don't get wrapped around the axle on wringing your hands because you made a mistake and the trade went against you. Always make it a choice. Now, you know, setting a stop loss point is not making a choice. You're arbitrarily saying, well, if it gets this bad, I'm going to get out. That's not really making a choice. It's certainly eliminating a lot of decision process, and that's fine. I mean, if you want to run a trailing stop and all that other kind of thing. In a longer term trade, in other words, if you're going to let that trade run for a couple hours or a couple of days or weeks or whatever, then you are going to want to do trailing stops, or if it's just a couple of days you're going to run, you may want to set some hard stop every day rather than trailing. You may want to just go in and change your stop point, and that's fine. But again, remember, I'm a day trader, and so the emotions that we feel as day traders are hyper enhanced as opposed to what you feel as a long-term trader. I mean, you make a stupid, really bad mistake and you've held the trade for a couple of weeks. It's not as stingy as if you make 4 of them in a row in 2 days. So by understanding our emotions and how to deal with them effectively as a day trader, again, that's another one of those skills that transposes up into the higher time frame trading, whereas those kinds of emotions are not going to transfer down to us as day traders. If you're coming in from trading a daily basis and you're going to come down and try to scalp or try to day trade, you're just going to get chewed up because you don't know what you're doing. When I was a kid growing up, my dad had a 12.5-foot Penguin class, a sailboat, and we'd go down in Chicago. I grew up in Chicago, so we'd go down to Lake Michigan and sail that with we were in a sailing club. And every year they had what they called the big boat skippers race. And that was always toward the end of the season when it was cold. Because these guys getting off their 30 and 50 foot boats, and some of them were Dragon class, which I think was a 24-foot boat, but still like a big keel and all that stuff. 12.5-foot boat, you breathe on the gunnel and the thing will tip, right? So you see these guys, and of course, massive drinking had to occur prior to the race. So anyway, you'd see these guys come down the dock and they'd throw their gear into the boat and they'd be all bravado and everything, and they'd step off the dock onto the gunnel of the boat and they'd flip the thing over and they'd be in the drink right away. It was hilarious. But the point being is there's some things that you can't transfer down in sailing on a big boat into a little boat, but you can certainly transfer what we learned as small boat sailors into the larger boats. There's more lines and more sails and more weight, more complexity, but those are all based on the same skills that you would learn if you're sailing a small boat. Anyway, exiting a trade because you choose to do so is to exit gracefully under your conditions. Your analysis of the situation at that particular time brings you to the conclusion that you probably should get out, and you exit. You're doing that by choice. You're not doing that out of fear. What you're saying is, I've squeezed this puppy for all the profit I could possibly get. I'm happy with that. I wish it would have gone a little bit further, but it looks like it's stagnating here at this point, and so I'm going to exit. That's a graceful exit, as opposed to sitting there with a trailed stop and you're watching the price, and the price is going like this, and it's like 10 pips or something above that trail, and then you watch that fucker go down and take you out for a loss of probably 8 pips more than maybe, or 20 pips more than what you might have done if you would have had the skill to judge when that price is going to change or top out. Now, the question comes, well, how do you know that the price has gone as far as it's going to go? Well, you don't. But through experience and looking at the momentum of the price action and evaluating the current candle or bar size in relationship to the normal ATR, which is again another momentum gauge, and several other things that you might want to consider what we call trade management, is you get a sense for when that price has run its course. Now, you can't be as abstract and say when price has run its course. Price doesn't know what the fuck it's doing. What do you call a dog with no legs? You don't bother to call him at all because he ain't going to come anyway. You know, you can't just say, oh, I'm gonna put this stop here. I mean, there has to be some calculation involved in this stuff, rather than just putting a limit stop on, or you know, making some abstract determination that the price is going to turn around. Why is it going to turn around? It's because of order flow. Who creates the order flow? We don't, as retail traders. We tend to create the order flow at the wrong time so that the institutional traders can take advantage of that by using us for their liquidity, right? But as far as the price doing anything, it doesn't know. It doesn't have any information about that. It's the culmination of the supply and demand of the institutional traders. So if you look back over the price action, if this has been a big order, you've seen this kind of thing before, as this same group of traders is trying to unload several billions of dollars in a short period of time. They got to run the price up and then they got to pull it down. They got to run the price up and then they got to pull it down in order to satisfy their client order. So you kind of get a sense, if you're only looking at one currency pair, you get to know that pair really well. It's like having your child. You can tell the difference between when that child is scared crying versus when the kid is crying to get attention and just to piss you off, right? So we become, we become intuitive traders, trading with the gut. Well, I don't think you could do that unless you're familiar with the underlying mindset and of an institutional trader. Not that you know what the particular campaign that he's on right now is or how big it is. It doesn't make any difference because it'll be different institutional traders all the time. You have to understand what they're doing and why they're doing it and who they're doing it for. And you look at that one currency pair that you're tracking and following, you're comfortable with that currency pair, and so that you get a sense for it. That's that intuitiveness. And so it's not necessary, if you're going to be a day trader, it's not necessary for you to set stops in order to manage your trade. You watch it. And when you have the sense, and I mean, if I have a student, I can work with that student. I can say, well, this is what I would do here. And why are you doing it? Well, look at the conditions. Look at what we've been talking about as we've judged this thing as it's going through. Look at my personality as opposed to your personality. Maybe you've had 8 winners in a row and you're riding high and you say, I'm playing with the house's money. Don't ever do that, but I'm playing with the house's money, and so I'll just see how far this fucker will run. And if I lose an extra 10 or 20 points, it doesn't make any difference because I've cumulatively made 60 or 70. So I'm willing to give up 20 with the gain of another 40 or 50. I mean, that's how you make your money. You don't just stop out when you hit your profit target. You gotta let that run. But as soon as you let it run beyond where you thought the profit target was, hopefully you've taken a little bit off the table so that you've made some money on the trade. But you can't exit out of fear of losing profit because the profit isn't there until you close that trade. So if you want to set a hard stop and it turns around and hits you out at 20 pips, you lose 20 pips, but you've already made 60. Well, let's say you made 60, you didn't make 80. You never did. You never had 80 because you didn't close the trade. So you're not losing 20 out of 80. You're losing nothing. You've gained 60. You have to look at the trade that way. So when you're managing that trade as it's moved past the profit target area, you have to realize you set that profit target because you felt that was as far as the price was going to go. So you need to be hyper. If you're going to let it run, you need to be hyper alert and have a sense of intuitiveness as that price continues to move up as to when you should pull the plug. If you are experienced, you've probably got, a 70% chance that that price is going to extend. If you feel it, your intuitiveness is saying, yeah, I think this is going to go. I think you're 70% correct there. So it could, excuse me, it could turn around and take 30%. Negative result and flip out and hit your stop. So because you have a 30% chance of the trade turning around and hitting a stop, where would you put that stop? And this is where I'm saying you don't want to have a hard stop. You may want to have a panic stop 20 pips below so that if you get a quick flush, I mean, the currency markets, if you're trading the right pairs, don't have gaps. They're going to get they're going to, most of the time, 99% of the time, even in a thin market, they're going to get your stop. But you probably ought to have a panic stop down there anyway. But that's not the one that you're going to exit the trade on. So you're watching this thing go, and you have to have this intuitive feeling, this isn't going well. It's not going the 70% that I thought. Maybe I'm only looking at a 55% chance. Well, that's almost jump ball. Get out. Why not get out? Because if the thing turns around and continues to go up, what the price has done by chattering at that level or by demonstrating being held up by some congestion of resting orders or whatever, If it does continue to go up, that's a new trade entry for you. And so you take it and you go. Now you're back to the same thing that you had before, trade entry. So you got to have good trade entry in order to jump back onto a trade. In fact, your trade entry has to be better at that point because you've already identified that that is the terminal point of that particular trade before you have a normal retracement of price. If you're looking for a 20 or 30 pip profit target, somewhere in there you're going to have a 5 or 10 or 15 pip retracement. Maybe that's it. Maybe that's the 15 pip retracement. Maybe that's an inflection point and that price is going to continue to go up. You don't know, so you get out. Or if you have experience and you say, I've got a 70% probability, and that's a whole other course in itself, is how you determine those probabilities. But I've got a 70% feeling, if you want to be that way, that this price is going to continue. Great, let it go. You might want to take a little bit more off if you've done multi-lot trade, but you let that go. And you watch it very carefully to when it starts to stagnate again. If it starts to stagnate fairly close to where it stagnated before, you're in a zone. You're in an absorption zone. Get out. Just get out. You know, the next step of trading beyond that, when you're watching that price move beyond the profit target, is add lots. Stage in more. Because if it continues to go, now you're picking, say it goes 20 pips higher, you add in, and the price goes 20 pips higher. And then it starts to stagger, and it comes 10 pips down, and you get out. You've made an extra 10 pips on all the remaining stuff that you've had, plus an extra 10 pips on the lots that you just added in. That's how you make money. You don't hang on to your losers and cut your winners short. You load into the winners. Most folks don't want to add into the winners because they have more of a fear of the loss of those extra lots than they have of a desire to gain. Well, again, you're in fear at the wrong point. You should be fear when the price has gone against you at entry, not when the price is going with you. It doesn't make any sense to do it that way. Exit your trades gracefully. Peter Rose, Longwood Currency Trading. Have a great day. Have a great trading day.